My plan for the next little bit is really just to kind of do three things. I'm going to quickly go over the cattle markets where I think we are now. I will give you what I like to call planning prices and my expectations for the rest of 2020, this fall market in particular, a little bit beyond. And then what I thought would be timely would be just to kind of do some high level plan for about the next 30 minutes or so. So I do want to start by just simply saying that, we came into 2020 with some optimism. I certainly did. And I've shared this before, but we did have a smaller calf crop. That was going to be there for a long time. We finally got there in 2020 for the first time. We're going to sell fewer spring-born calves this fall. We had a lot of optimism on the export front, and it seems like forever ago. But back last fall, I was talking about reduced tariffs with Japan. I was talking about USMCA. I was talking about African swine fever in China, and I was talking about how the market had opened up for us to send poultry to China, and all those things were going to be positive in terms of beef exports for 2020. So it really should have set up for a better year for us, and especially the second half of 2020. So right now we're first of September, we really should be right. We should have been right now reaping kind of the benefits of what I thought we were setting up for coming into this year. COVID really hit us in three waves, and they got progressively worse as each wave came. Wave one, looking back, was nothing. It was it was negative at the time, but it ended up being very small. It was just the impact from the impact of reduced export demand due to COVID, particularly in Asia. And then phase two is what hit us first, and that was just kind of the cancellations and layoffs and decreased activity. So think about what happened about the middle of March to the first part of April. It's kind of that uncertainty. That also is associated with a major shift away from home consumption towards at-home consumption of beef products. And I think just a lot of that uncertainty and that adjustment is what hit us right off the bat there into March. And then the real story, though, came really in April through about early to middle part of May, and that was supply chain disruptions. And the real market impacts that we saw, the fundamental differences were what we saw when plants had to shut down and when other plants had to pull back on production. We saw some major changes, and I'll talk through some of that. It was all complicated, though, by the fact that we just had higher production levels, especially the first half of this year. So I want to update us on where we are, first of all, in terms of cattle slaughter, because that was, I think, the biggest impact this spring. If you look at where we actually got, this would be, I think, the second week of May, I think it was kind of the bottom, if you will, of slaughter. But we were running about 35% below 2019 levels in terms of slaughter, and you just simply cannot impose that kind of shock on the market and not see impacts on both ends. We saw impacts on cattle prices, we saw impacts on box beef markets, and folks, we saw impacts at the grocery store. You heard a lot of those things about just simple availability. We didn't run out of meat, but certainly we saw a difference in selection, availability, and it was just how much we get different times. So that was, I guess, the big impact of these markets. Now, notice, though, where we've been, honestly, since about the end of June, okay? We've been running 1 to 2% below 2019 levels. And when you think about what a lot of these plants have had to put in place in terms of worker spacing, plant speed, sanitation, some have even had to put in dividers and support between employees. I really think it's pretty impressive that we've been moving as many cattle through these facilities as we have been. I think it speaks pretty well to how resilient our meat system is. Before I get into more Kentucky level prices, and I'm going there in the very next slide, but I do want to talk quickly about slaughter steer prices. What we saw in terms of fed cattle price towards about the end of April, first part of May, this really was the processing plant shock disruption. Got a nice lot of things picked back up. What we saw early June, that probably was more what I would call our typical seasonal bottom. And I've been really encouraged that we've actually moved up from there. And it looks like that is going to be our bottom. One of the things I have worried about the last several years is that fed cattle prices have seemed to want to bottom later. So a summer bottom was certainly good news this year. And I think that's what we've seen, and we had our bottom in July. Naturally, the closer we got to finished cattle, the bigger the impact of COVID was. And, we came into 2020 with 8-week steers in January, state average bases in the low to mid 130s, groups around 140. Notice though, we took off about $25 a hundred off of those heavy steers from January to April. And that's a heck of a hit, $250 per head. Now we've added a lot of that back. As I've talked to you today, those same steers, state average are in the upper 120s. If you look at groups in the 8s, you've got some 136 to pushing a nickel a pound off what I thought would be not have to over this backlog of cattle. I made the comment in my market update last Friday that this is about the flattest calf market I've ever seen. But what gives the calf market its seasonality is grass demand in the spring, like we usually see, like we saw a red line there in 2019. And just the glut of calves being sold at weaning time in the fall of heading into winter. And we certainly did not see the former this year. We were not able to see any sort of price peak at all. But, one positive has been this calf market's been trying to slowly gain some steam, and it's actually increased from June to where it is now, which is atypical, but encouraging in one sense too. And the last market that I'll review quickly is our cull cow market. And this has been a bit of a bright spot. A lot of discussion about that it's a ground beef-based market, it is. But, the other thing that I would point to, and this has kind of been a little bit under the radar screen, but we didn't see anywhere near the supply disruption in the cow markets that we saw in steer and heifer markets. Whereas our steer and heifer processing numbers were down at one time 35%, the cow slaughter numbers, and I didn't separate beef versus dairy, but just cow slaughter in general never got below about 8% below 2019. So we didn't see near the supply or near the processing reductions on the cow market that we saw in the true fed cattle markets. Secondly, I want to hit head on this notion of this backlog of cattle in the system, because really that's what I think a lot of folks have been worried about all summer long. And I'm certainly more encouraged about where things are than I would have been if I'd been talking to you even 2 months ago. I showed this chart earlier, but one of the things I try to do is get a feel for, okay, how many cattle are out there and how many are going to have to move through the system, period. And, I mentioned the timing on COVID and the shutdown was tough because, our cow numbers for this cycle look like they peaked in 2019. But that means our calf crop already peaks that year, and our true numbers to run with the system probably peak in 2020. So we were vulnerable, I think, in general because of just where numbers were. If you look at us across the board from January to where we are now, we've slaughtered about 850,000 fewer cattle under inspection than we did in 2019. And we should have been running more through the system this year. So that puts that in somewhat of a perspective. Now, I want to show you a couple things that I've been this. But if you look at the lines, we are moving back to what looks like it's closer to where we were last year. And it's certainly encouraging that we're starting to see that. Interestingly, although I do think the steer chart does show that weights are pulling back something more to 2019, I think it'll be fall before we actually see them come down. If you look at heifer weights, they're almost where they were last year. So interesting to me that we're starting to see, I think, this come into play as we speak. The other thing that I've watched a lot that I find very interesting is, I want you to notice what I'm showing you here, blue line is 2020. It's the number of cattle that have been on feed over 90 days. And this is another measure of how current the market is. And when you saw what we saw back in about June, this tells us point blank, we're not moving enough cattle through the system to keep unloading these longer fed cattle. But notice how quickly that dropped in July and August. And talking to you now, this is about a normal cattle on feed mix. We're about where we would normally be given the total number of cattle that are on feed right now. So we've moved a lot of those longer fed cattle in the system, and that was step one to working us through this backlog. Now, last thing I want to say, I do think our on feed numbers look a bit more normal now. Placements picked up quite a bit last month, and I'll mention that in just a second. But, the other, cattle can be backed up at different levels, right? We can talk about cattle being backed up on feed, but, the bigger concern, I think, was how many cattle were backed up in the country that had to be put on feed and were consistent down the road. We don't get near as good a measure of this because we don't have a monthly number like we do for cattle on feed. But we can take those July 1 cattle inventory numbers and we can look at some of the categories and make an estimation of how many cattle there are to work the system. If you look at where that stood July 1, and again, I'm basing this strictly on USDA NAS numbers, okay? But I do think their NAS numbers are typically pretty solid. We had about 300,000 more cattle that were outside of feed yards that were probably going to work through the system, okay, in 2020 than we did in 2019. So that's a significant number of cattle. But to put it in perspective, that's less than 1% of total numbers. Okay, so yeah, it's significant, but I think when you put it in perspective of total numbers, it's not quite as daunting a number when you think about it. One cautionary note on that, though, is the vast majority of those, in fact, all of them, in fact, were cattle that were heavier, meaning that it had kind of been backed up. So think about cattle that have been in some sort of background in the stocker type operation. So I'm not talking about calves, because this calf crop's smaller. So while we may have had 300,000 more total cattle outside of feed yards, we had about 400,000 cattle that were in those heavier weight categories. So think about steers and heifers and even and third. And that was the more problematic concern in July. If you look, though, at July feedlot placements, they jumped 188,000 head from 2019 and jumped almost 100,000 head from June. So when I put this number in perspective and think about what we're likely to see, I think we'll see a very similar thing when August placements come out at the end, or I guess, the third week of September. I think we've largely worked through this backlog, and I think that's very encouraging. Is why we've seen these feeder cattle markets move like they have the last 2 weeks. So I'm much more encouraged than I would have been even 6 weeks ago. So this market continues to evolve, but heavy feeders that are moving now, and honestly between now and about November, are going to be placed, into an environment where they're going to be selling on a spring board that is relatively attractive given where we've been. So I don't see a lot of reason to think that these heavy feeders are going to pull back a whole lot between now and middle to end of fall. If I was giving you kind of an October-November price, I'm thinking, roughly 3 to 7 weeks down the road. I still like these 8-weight steers, these groups in the mid 130s and the straight average in the mid 120s. So I'm only pulling them back $3 or $4 north from where they are now, which would actually be pretty encouraging as we are right now at what is our typical peak for heavy feeder cattle prices. They usually peak sometime in the August, early September. So not what we ideally would have seen, but I certainly would have taken this in the spring and ran with it in a heartbeat. My only concern on the calf market is that we have and are going to continue to place more of these heavy feeder cattle that are kind of backed up outside of feed yard. We've done that, I think, and they're going to do it again this month. Freshly weaned green calves this fall? The answer may be yes. There's only 3 places they can go. They can go into backgrounding type operations. They can be put straight on feed, and that happens a lot of times in fall. But then the closest thing that we have to a stocker operation in the fall is we have wheat grazing. And I think this really may be a year when wheat grazing has a big impact on our fall calf market. Pre-hurricane, I would have been very concerned that the wheat grazing market might have been a negative on our calf market. But things have changed a lot the last few weeks. Conditions look much better. So I think we'll see some pretty healthy wheat placement this fall. All that said, I'm actually forecasting a calf price higher than where it was last year. I'm going to estimate state average my 40, and that means that these brood values are going to be somewhere, 150 to the low 150. Calf market, where we were back in spring, how things looked, to be forecasting a price higher than we saw in 2019 to me is encouraging. It's a small win for us. The other thing that I would say is that given that I do have some concern about placing some of these calves directly on into feeding situations, I don't know that feedlots are going to be looking for a lot of that, given that a lot of these heavies that are going on feed the last few months. It probably is a good year to be thinking about selling preconditioned calves or just simply not selling green calves. The other thing is, when a lot of us wean our calves in the fall of the year, it's a little bit ahead of when these wheat grazing operations are looking to place calves. So another advantage of doing that is you put on some gain, obviously, you move into that value-added category, sort of that green calf category, but you give it some time too for the wheat grazing demand to kick in, which I think may actually help things quite a bit this year. Last thing I'm going to do is just very quickly walk through some price risk management considerations. And anytime we have a year with major price swings like we had in 2020, I get a lot of questions about risk management. But, COVID was a total black swan event, and that's that kind of hard to predict, major potential impact type things that we just simply have in your mind. But, risk management really is all about planning for the unknown. And while COVID is on the front of our minds, weather, international trade, any sort of shock in demand, policy changes, all those things can impact these cattle markets and do so very quickly. So COVID was just kind of one example, but it just hit us pretty hard this year. But every year is a good year to think about risk management. Understand too, there are no counter-cyclical opportunities that exist in cattle markets. We can't resurrect good prices. We have to be forward-looking and thinking about taking advantage of markets when we don't know that they're going to be dropped. We're all used to managing soil fertility, we're used to managing our forage, used to managing our health programs, but I think we have to add price risk to one of those things that we simply have to manage because it's just becoming more volatile all the time. I'm going to give you some quick high level about 1 minute on each of these, just background on 5 different risk management tools that are out there. Forward contracting, internet sale with delayed delivery, simple hedging using futures, price floors using options, and then I'm going to end by talking about livestock risk protection insurance. And I'll do so very quickly, very high level. I'll do some more on this over the winter and more detail, of course, but just kind of big picture stuff. Here's what to be thinking about. We don't forward contract very many cattle in Kentucky for a handful of reasons. And when folks think about this, they typically think about contracting with a feed yard, but frankly, you can contract with a stocker operator or a background or anybody that might buy casual feeders. When you forward contract, you really convert price risk to production risk. If you enter a contract to deliver 775-pound steers at a certain time, then once you enter that contract and you've locked in a price, now everything becomes production risk. You got to get them there. You got to get them there weight-wise, quality-wise, and physically get them there. So in a lot of ways, you become a professional marketer by doing that. You've got to know the value of your cattle. You've got to build relationships. And this is tough to do as far away as we are from a lot of major feed yards. So, things that we take for granted, like payment security, for stockyards, that becomes an issue when you forward contract. Range for transportation, risk, risk getting them out there. What if they get hurt, loading and transportation? A lot of that stuff we take for granted with the auction system. Something else I say is that if you sell cattle through the auction system and there's a problem with your cattle and they get on feed somewhere out west, they don't call you, they call somebody else. If you forward contract and send those cattle out, you're going to get that call for this problem. So be aware of the world you're stepping into. We can use internet sales to essentially have a forward contract on cattle, and you see this sometimes. You see folks that might advertise their spring-born calf crop in the summer for delivery sometime in the fall, or they might advertise a group of calves grazing in a stocker program. They might video them and sell them maybe in July, and they're going to deliver maybe in October. So you can essentially convert the auction system into a forward contract by using internet sales with delayed delivery. Everything I mentioned about forward contracts largely applies, and you're going to have to learn a few things like how to specify weight conditions, shrink, how to deal with slack, things like that. But you can also build a reputation over time. And if you sell good cattle this way, and get multiple folks excited about them, 1 or 2 more bids, folks, in an auction environment like this can make all the difference in the world what your cattle burning. So that really should be your goal, and you can use internet sales to build a reputation like anything else. Third, simple hedging with futures. I bet I've done darn near 100 programs over my career on using futures and options to manage price risk in feeder cattle. But the idea here is that things that impact the feeder cattle futures market should also impact the markets for our cattle here in Kentucky. So they should move together. So if I sell a futures contract for the month that I plan to eventually sell cattle, I'm worried prices are going to go down. If it does, I make money on the futures contract. That should partially offset what I what I'm losing on the fact that cattle are worth less. When you use futures, this is true of any future strategy, you're really trading price risk for basis risk. Price risk is no longer the problem. You've locked them in on the board. What your new risk is, though, is basis risk. How does the Kentucky price that I sell for compare to what the futures market actually is? The reason a lot of folks don't like to use futures directly and hedging this way by selling futures contracts is margin call. And put simply, you've got to have access to liquid cash. Those cattle and benefit from that higher market. For most of us, what that means is work with your lender. Your lender needs to know what you're doing, and they need to be prepared that you may need some capital access to make some margin call, because that's how you're going to benefit from the price down the road. Options are an opportunity to set a price floor. An option is just simply the right to sell, and you do that only if the market moves downward. So, if all feeder cattle futures are 140, and you buy a put option with a strike price of 134, what you're doing is you're buying an option that gives you the right to sell futures at 134. Futures market falls below 134, then you start to make money on that put option. A lot of folks like options because but the nice thing is if the market goes up, you don't lock in that lower price like you would with a forward contract or with the straight hedge. So options give us another strategy that I do like. Two things to be aware: you're going to spend some money. Option premiums can be significant. Most folks that buy puts anywhere near the money are going to spend 25 to maybe 40 bucks a head on a group of heavy feeders to get some level of price protection in place. And on top of that, they're going to have to self-insure the difference in the market and that strike price. So my simple example I just gave, boards at 140, I buy strike price at 134. I've got to eat the first $6 drop in the market before my option kicks in. So just understand you've got some deductible, some self-insurance there you've got to deal with yourself. Last thing I'm going to talk about is livestock risk protection insurance, and this program has been evolving for many, many years. It works really just like a put option. It's analogous to a put option. You're buying a policy that will pay you if the CME feeder cattle index is below a certain level on a specified date. So you can purchase a policy as little as 13 weeks out, and then every 4 weeks out from there on. So 13, 17, 21, and so on. They're a bit less flexible than options, and if they were the same price and you could use either, I would push you towards an actual option. Talk about it, I pretty much got to have a feeder cattle, and if I put option, I've got to have 50,000 pounds worth of feeder cattle. With LRP insurance, I don't. I can buy LRP insurance on 30, 20, 10, 15 head if I want to. So the fact that it's scalable means it's the only thing I've really got, the only tool I've got for a small operator that wants to manage downside price risk. The other thing to be aware of is that the subsidy levels on the premiums for LRP have increased quite a bit over the last few years. When I first started talking about LRP, premium was 13%. And it was not even clear from time to time what the better buy was between an option or LRP insurance. They bumped those premiums up now between 25 and 35%. The premium is lower at higher coverage levels, but 25% folks is pretty darn significant. So don't sneeze at that. It's something that if you've not looked at in the past, or it's too expensive, it might be worth another look. It is the only tool we've got for folks that are relatively small. Probably should be kind of gauging my time here too, but you want to also just kind of think big picture about where you are with your program. A few things I always like to kind of leave folks with is, you really want to understand how price changes are going to impact your bottom line. And, think about summer stock operators, year in, year out, if they can make $50 to $100 a head, they're generally happy. Understand that means a 10-cent change in feeder cattle price is the difference in hitting your target profit and possibly losing money. And we all know the market can swing that quickly. Calf markets, it takes about 15 bucks a hundred to do that exact same thing, but just understand how sensitive our returns are to sale price. Know what tools are out there. I mentioned 5 briefly, but these are things that are constantly evolving. I'm convinced there'll be some more price risk management tools in the next couple of years on the marketplace for you to look at. always tell folks, don't do anything you don't understand. I've got a couple of horror stories, folks that have, reached out to me and said, Kenny, I bought a put option and now I'm getting margin calls, something's wrong. And when they send me their information, I realize, well, actually, yeah, they bought a put. They sold somebody a call. So the fundamental mistake was they did not really understand what they had done. And I think you always want to make sure, whether you do this yourself or outsource it from sort of marketing company, that you know what you're doing and understand why you're doing it. I tell people too to set pricing targets ahead of time. There's nothing wrong with pricing cattle very early. If you're a margin operation, I don't mind if you price cattle the day you buy the cattle. That's perfectly fine. If you choose not to do that, though, I always like to tell when the market's dropping, it's hard to lock in a price that's going down. When the market's going up, it's hard to lock in because you think the market's going to go up further. So set targets ahead of time, and then that takes the emotions out. When it gets where you want it, you jump on it, automate it, done, and then don't look back. With risk management, understand the goal is not to maximize price. It's to take out some of the really undesirable outcomes. So you really are seeking long-term stability. You're not chasing high prices. There's going to be years you are going to leave money on the table if you do a good job managing price risk. But my argument's always been, if you're not leaving money on the table occasionally, you're probably taking too much risk in some of those years too. So just understand that's part of the way that this goes. I'm going to leave with my contact info.